I'm the banking center manager at Comerica Bank in West Hollywood location. There are different ways to tap into home equity and or make changes on the existing loan on your home. The smartest way to determine which avenue to take depends mostly on what you want to do with the money and for how long. Today, we'll review 3 options of refinance, reverse mortgage, and home equity line of credit known as HELOC. But before we dive in these 3 topics, let's review first what home equity is. Home equity is the value of a homeowner's interest in their home. In other words, it is the real property's current market value less any liens that are attached to that property. The amount of equity in a house or its value fluctuates over time as more payments are being made on the mortgage and market forces impact on the current value of the property. With that said, let's start with the option of refinance. A refinance, or refi for short, refers to a process of revising and replacing the terms of an existing credit agreement, usually as it relates to a loan or a mortgage. When a business or an individual decides to refinance a credit obligation, they effectively seek to make favorable changes to their interest rate, to their payment schedule, or other terms outlined in the contract. If approved, the borrower gets a new contract that replaces the original agreement. Now we'll review the various reasons that people may choose to do the refinance. There are obvious and less obvious reasons for this. For instance, falling interest rates. This is the most obvious reason to refinance. When interest rates fall, a new loan means lower financing costs. Perhaps you took out a loan, a 30-year fixed mortgage when rates were at 6%. Now they're down to 4.5%. On a $300,000 loan, that rate drop alone would lead to a $279 reductions in your monthly payments. In a case like that, doing a refi might sound like a no-brainer, but you should keep in mind that taking out a new loan means paying new closing costs, and those may or may not be worth the savings from a lower rate, depending on how long you expect to live in that property. As a general rule, the longer you plan to stay in the house, the more it makes sense to refinance and absorb those one-time fees. Second reason for refinance might be replacing an adjustable rate mortgage known as ARM. This is a good reason. If you have an ARM and you like to convert it into a fixed rate loan, you want to go the refinance route. An ARM is a loan that offers a low introductory interest rate that resets after a predetermined period of time, whether it's 1 year from your closing date, 5 years or more. If interest rates have gone up when the loan resets, borrowers can be in for a shock when they see their new monthly payment. That's why borrowers will often try to refinance into a fixed rate loan before the reset date, especially when rates are relatively low by historical standards. The fact is that no one knows what will happen to the interest down the road. Therefore, opting for a safer bet is usually a good idea, especially if you plan to be in your home for a while. The next reason for refinance might be your credit score has improved. Perhaps you took out a home loan when your credit score was a lot lower than it is now, leading to a higher than average interest rate. Since then, you've reduced your debt balances, perhaps even regularly sending in your payments before the due date. Your ability to pay back the loan on time is one of the biggest factors in determining your mortgage interest rate. If your credit score has improved significantly, you may be eligible for a substantially better rate. Another reason for refinance might be lengthening the loan term. Even when the rates are the same, some homeowners are able to lower their monthly payment by refinancing. They simply take out a new loan with a longer term. For example, you took out a 30-year mortgage for $250,000. 10 years later, the loan balance is down to $200,000. By taking out a new 30-year loan for the remaining balance, you're lowering your monthly payment, but you're also tacking 10 additional years onto your loan. Extending your loan term might make sense if you're having trouble keeping up with your payments. Still, make no mistake, by stretching out your mortgage, you'll be paying more interest in long run. Another reason for refinance is taking cash out of your home. Among the perks of owning a real estate is the opportunity to build equity over time. When times suddenly gets rough, as they have during COVID-19 pandemic, a home can be a source of needed low-cost cash. This cash might be used to consolidate high-interest debts you carry on your credit cards or other personal loans. A cash-out refinance can help improve your cash flow and save your money in long term, possibly even if you take a slightly higher mortgage rate. And lastly, refinance can give you the option of eliminating mortgage insurance. If you have a home loan with private mortgage insurance, also known as PMI, a refinance could help lower your monthly costs. This is especially true if you have a loan insured by the Federal Housing Administration or FHA. While FHA loans can be a viable path to homeownership for borrowers with little savings or not so stellar credit, they come with a big downside, and that's the mandatory mortgage insurance. After paying an upfront premium, most FHA borrowers continue to pay an annual mortgage insurance premium for the remainder of the 30-year term that cannot be canceled, which adds up over time. To eliminate PMI, homeowners can refinance an FHA loan into a conventional mortgage once they gain 20% equity in their home. Now we can review the several types of refinancing. So some of these refinancing options include rate and term refinancing. This is the most common type of refinancing. It occurs when the original loan is paid and replaced with a new loan agreement that requires lower interest payments. There is cash out refinancing. These are common when property has increased in value. The transaction involves withdrawing the value or equity in the property in exchange for a higher loan amount. In other words, when an asset increases in value on paper, you can gain access to that value with a loan rather than by selling it. This option gives the borrower access to cash immediately while still maintaining ownership of the asset. Another one is cash-in refinancing. A cash-in refinance allows the borrower to pay down some portion of the loan for a lower loan-to-value ratio or smaller loan payments. And lastly, consolidation refinancing. In some cases, a consolidation loan may be an effective way to refinance. A consolidation refinancing can be used when an investor obtains a single loan at a rate that is lower than their current average interest rate across several credit products. This type of refinancing requires the consumer or business to apply for a new loan at a lower rate and then pay off existing debt with the new loan, leaving their total outstanding principal with substantially lower interest rate payments. Of course, there are advantages and disadvantages to refinance. So let's first review what the advantages are. You can get a lower monthly mortgage payment and interest rate. You can convert an adjustable interest rate to a fixed interest rate, gaining predictability and possible savings. You can acquire an influx of cash for a pressing financial need. You can set a shorter loan term, allowing you to save money on total interest that is paid. As you've owned your home, made improvements on it, and paid off your mortgage over the years, you've built up a stockpile of equity tied to your home. Refinancing can provide access to some of that equity, giving you a safety net of money. What the cons are with refinancing is that if your loan term is reset to its original length, your total interest payments over the life of the loan may outweigh what you save at the lower rate. If interest rates drop, you won't get the benefit with a fixed rate mortgage unless you refinance again. You may reduce the equity you hold in your home, especially if you do refinance with cash out. Your monthly payment increases with a shorter loan term, and you have to pay closing costs on the refinance as well. Now let's move to the next option for homeowners, which is reverse mortgage. Reverse mortgage is a loan. A homeowner who's 62 or older and has considerable home equity can borrow against the value of their home and receive funds as a lump sum, fixed monthly payment, or a line of credit. Unlike a forward mortgage or the conventional mortgage, which is the type used to buy a home, a reverse mortgage doesn't require the homeowner to make any loan payments. Instead, the entire loan balance becomes due and payable when the borrower dies, moves out permanently, or sells the home. Federal regulations require lenders to structure the transaction so the loan amount doesn't exceed the home value, and the borrower or borrower's estate won't be held responsible for paying the difference if the loan balance doesn't become larger than the home's value. One way this could happen is through a drop in the home's market value. Another is if the borrower lives a long time. In any case, you will typically need at least 50% equity based on your home's current value, not what you paid for it to qualify for a reverse mortgage, of course. And the standards vary by lender. When you take out a reverse mortgage, you can choose to receive the proceeds in one of 6 ways. So one way is receiving a lump sum. Get all the proceeds at once when your loan closes. This is the only option that comes with a fixed interest rate. The other 5 ones that we'll discuss have adjustable interest rates. The second way is through equal monthly payments or annuity. For as long as at least one borrower lives in the home as a principal residence, the lender will make steady payments to the borrower. This is also known as a 10-year plan. Third way is through term payments. The lender gives the borrower equal monthly payments for a set period of the borrower's choosing, such as 10 years. Fourth is through a line of credit. Money is available for the homeowner to borrow as needed. The homeowner only pays interest on the amount actually borrowed from the credit line. So if you don't borrow, obviously you won't have any payment to make. Fifth way is through equal monthly payments plus a line of credit. The lender provides steady monthly payments for as long as at least one borrower occupies the home as a principal residence. If the borrower needs more money at any point, they can access the line of credit. And lastly, term payments plus a line of credit. The lender gives the borrower equal monthly payments for a set period of the borrower's choosing, for example, 10 years. If the borrower needs more money to access during or after that term, they can access the line of credit. Reverse mortgage comes with its pros and cons too. Some of the advantages are that it helps secure your retirement. Reverse mortgages are ideal for retirees who don't have a lot of cash savings or investments, but who have a lot of wealth built up in their homes. A reverse mortgage allows you to turn an otherwise a liquid asset into cash that you can use to cover expenses in retirement. You can continue to stay in your home. Instead of having to sell your home in order to liquefy your asset, you can keep the property and still get cash out of it. This means you don't have to worry about potentially downsizing or getting priced out of your neighborhood if you had to move. You'll pay off your existing home loan. Your home doesn't have to be paid off in order to take out a reverse mortgage. In fact, you can use the proceeds of a reverse mortgage to pay off an existing home loan. This frees up money to put toward other expenses that you may have. You won't have tax liability. According to the IRS, money you get from a reverse mortgage is considered to be a loan advance rather than an income. That means the funds aren't taxed, unlike other retirement incomes such as distributions from a 401k or IRA. You're protected if the balance exceeds your home value. In some cases, the value of your home could end up being less than the total amount owed on the reverse mortgage. This can happen if home prices fall, for example. If this occurs, your heirs don't have to worry about paying the balance. Now, the downside of the reverse mortgage is that you could lose your home to foreclosure. In order to qualify for a reverse mortgage, you have to be able to afford your property taxes, your homeowner's insurance, the HOA fees, and other costs associated with owning your home. You're also required to live inside the home as your principal residence for most of the year. If at any point during the loan period you become delinquent on these expenses, or spend the majority of the year living outside the property, you could default on the reverse mortgage and lose your home for foreclosure. Your heirs could inherit less. Homeownership is a key path to building generational wealth. However, a reverse mortgage usually requires the home to be sold to repay the debt. When you die, heirs will be required to pay the full loan balance or 95% of the home's appraised value, whichever is less. Usually that means selling the home or turning the property over the lender to satisfy the debt. Not to mention a reverse mortgage, it's a way at your home's equity. By the time it needs to be paid off, there may not even be any equity to be left to your heirs. Reverse mortgage is not free. You might not have to make payments with a reverse mortgage, but there are still plenty of expenses associated with it. Not only do you have to keep up on your taxes, which I mentioned, insurance and HOA fees, but you also have to pay an upfront insurance premium. Usually this is 2% of your home's appraised value. You'll also pay origination fee at closing. You do have the option of rolling these costs into your loan balance, and that means you receive less money. Reverse mortgage could impact your other retirement benefits. A reverse mortgage may not be considered income for tax purposes, but it would impact your ability to qualify for other need-based government programs, such as Medicaid or Supplemental Security Income, known as SSI. It's a good idea to discuss this with a benefits specialist to make sure your eligibility won't be compromised before you apply for a reverse mortgage. And lastly, reverse mortgages are complicated. There are a lot of rules to reverse mortgages. These loans come with many risks that may not be worth the extra cash. You should be wary of any reverse mortgage offers unless you understand the terms really well. Lastly, let's review the optional pulling a home equity line of credit against your home, known as HELOC. A home equity line of credit is a revolving line, usually with an adjustable interest rate. which allows you to borrow up to a certain amount over a period of time. HELOC works in a manner similar to credit cards when you can continuously borrow up to an approved limit while paying off the balance. Let's talk about some of the features of HELOC. Home equity lines of credit are secured by the equity in your home. Although HELOC shares similar characteristics to a credit card, since both are revolving credit lines, a HELOC is secured by an asset, which is your house, while credit cards are unsecured. In other words, if you stop paying your payments on the HELOC, called default, you could lose your home. A HELOC has a variable interest rate, meaning the rate can increase or decrease over the years. As a result, the minimum payment can increase as rates rise. However, some lenders offer a fixed rate of interest for home equity lines of credit. Also, the rate offered by the lender depends on the credit worthiness and the amount you're borrowing. HELOC terms have two parts. The first is a draw period, while the second is repayment period. The draw period during which you can withdraw funds might last 10 years, and the repayment period might last another 20 years, making the HELOC a 30-year loan. Once the draw period ends, you cannot borrow any more money. During the HELOC's draw period, you still have to make payments, which are typically interest-only payments. As a result, the payments during draw period tend to be smaller. However, the payments become substantially higher in the repayment period since the principal amount is also added to the interest-only payment. It's important to note the transition from interest-only payments to full principal and interest payments might be quite a shock, and borrowers need to budget for those increased monthly payments. Let's review the advantages and disadvantages of home equity lines of credit. With a HELOC, you can get lower interest rates and larger limits than credit cards and other loans. The payments would always be based on the borrowed amount, not the line limit. There are no regulations about what the money can be used for, but you can get a tax benefit for certain purchases. It's very common to utilize HELOC on using as a source of down payment for purchase of a real estate, consolidate high interest debts, tuition, home improvements, and also lend to own business. There are often teaser rates for the introductory period, which help pay less on immediate draws online. Borrowers will have the interest-only payment option during draw period, which helps ease the burden on monthly debts. And lenders oftentimes cover the closing costs of HELOC, such as appraisal, title, and credit report fees. The pitfall that may occur is that there is a set withdrawal period after which you cannot access any further funds. The withdrawal period is referred as draw period, which is typically for 10 years. There can be fees associated with HELOC, such as annual fee or early termination fee, which may apply if the line is closed within a certain period after opening the line. There can be limitations to how to access the funds. For instance, you may not be able to access the line as easy as you would access your checking or savings account, and you may need to take some extra steps to do so. HELOC has usually variable rates. The interest rate can rise, and so do the payments as a result. The uncertainty can make it difficult to determine the overall cost of a HELOC. HELOCs make tens of thousands of dollars readily available to you, and spending it feels just like making any other purchase. Under these conditions, it can be easy to rely on a HELOC to pay for purchases that your monthly income can't cover. Getting into the habit of living beyond your means is dangerous and makes it extra difficult to get by if your financial situation changes for the worse. Well, this concludes our presentation today. I hope it provided useful information that can help you make decisions on what route to take in future. Thank you.